everybody. This is episode number 27, July 9th, 2025. We had a very nice day today. Bitcoin went up, 2 or 3%, something like that. I didn't check what is the latest price, but we're above 111. Our show is called The Physics of Bitcoin Show. And we always make a little introduction about the show. It's basically two physicists, two astrophysicists, me and Steven. We have a PhD in astrophysics. We have kind of eclectic careers because we started in the field of astrophysics, but then at a certain point in our career, I did teaching, in a small college for about 8 years. Then I went to Northwestern, a bigger school, and I did something completely different. It is neuroscience. I work in the neuroscience of sleep, but the common theme, and Stephen instead started to go more in the industry field, working in the field of computation, different high-end supercomputing, but also sales at a certain point. But the common theme of these eclectic careers is that we were able to use some of the basic way of thinking that we were trained through our experience as a physicist. Because thinking as a physicist changes your perspective on the world. There is a very systematic, very particular way of thinking about problem from foundations and using different tools. It's all evidence-based. It's all mathematics and statistics and based on real life experiments. And we apply this to different fields, and we were successful because that is, it's a universal tool that you can apply to many different things. In fact, actually, some of the things that Stephen will talk about today, this book that he's going to review for us, it's actually exactly that, like how to apply things that as a physicist we discover in a particular field of science or reality, and then apply it to something else. And we came to Bitcoin kind of in this fashion, where being physicists, everybody comes to Bitcoin and brings their skill, their worldviews, their life experiences, and then find something in Bitcoin that reflects this, right? That is one of the beautiful things about Bitcoin. And so as a physicist, of course, we immediately try to apply our knowledge, understanding, and worldview derived from physics. And it was very successful because immediately we started to see patterns, regularities that are very universal, but also typical of Bitcoin. And so this show is all about this, and talking about this regularity, these patterns, this analogy with physics. And it's very unique because we don't know many other people that are doing this. We're trying to make our group bigger. We are also creating an institute. We kind of still talking about the name. We will announce it when we finalize. Right now, let's say the working name is Bitcoin Scientific Research Institute, but some variation around this name. And we are bringing more people, more talent, to study Bitcoin as a scientific topic, basically. And the show is all about this, about highlighting these aspects, where you can understand Bitcoin as a scientific phenomena. So evidence-based data, regularity patterns, and also mechanism, why Bitcoin is doing what it's doing, what are the possible mechanisms, right? Why? Because these patterns are not random, are due to very precise things that happen in Bitcoin. So it's a deeper way of looking at Bitcoin and understanding Bitcoin. Do you want to elaborate on this, Stephen?
No, that's great. Yeah, we're excited about forming this, and we'll settle on a name soon, and we look forward to our formal announcement.
Great. Okay. Then Stephen we'll go to the topic of tonight. With this is discussing the part of what we are going to do is also looking at the literature, like scientific papers. We are going to review them, but also interesting books that the public can read, because usually these books that we are going to review, they go a little bit deeper, but they are not super technical, and like the one that will be discussed tonight. Okay, go ahead,
Great.
Stephen.
So this book is by Didier Sornat. He has popularized the use of the log periodic power law for many applications. He started out as a geophysicist, so he used it, for earthquakes and avalanches and those kinds of things. But he gravitated towards using it towards financial time series. And so this book he wrote in 2003, Why Stock Markets Crash. It is technical. It's pretty dense. It does have equations, but it's got a lot of charts. And I think, going through looking at the charts, and we'll show some of those, helps illustrate, what's going on. So let me just bring up the slides and we'll dive in. Okay, so I've titled this 27th show Crashes, Bubbles, and Anti-Bubbles. His book is titled Crashes, but it's really about how bubbles develop, and the log periodic power law is a mechanism to model bubbles, but also you can use it on the downside for what he calls the anti-bubbles. And that, of course, is the crash. So a lot of this book is really about the rise and the crash. And we're going to focus on particularly chapters 6 and 7, which are kind of the core of it all. Let me just read the titles for chapter 6 and 7. Chapter 6 is Hierarchies, Complex Fractal Dimensions, and Log Periodicity. So the key concept we want to talk about today is log periodicity and looking at things in log time. Chapter 7, Autopsy of Major Crashes, Universal Exponents, and Log Periodicity. So as you can see, log periodicity is key here. And that's built around log time. So we'll talk about that. We'll talk about bubbles and anti-bubbles, and we'll demonstrate all of that. And the core of it is the log periodic power law. And one of the things I want to teach you how to do is to think about how many waves do you have as you bubble up, or as you crash down and anti-bubble down. And so there's this concept of frequency, which is defined in the LPPL model and equation as an angular frequency, but it's tied to a wavelength parameter, but that's in log time terms. And then the idea is to try and figure out what is the critical time, which is the most likely time at which you could get a crash. And then I'll do an update for the LPPL applied to Bitcoin and some forecasting, for the rest of the year in terms of Bitcoin price behavior. It turns out to be very timely relative to the tweet that you sent out yesterday, Giovanni, about how you think it might develop through the rest of the year. And it's concordant with that. So we'll reveal that. Okay, so first let's think about log time and log periodicity in nature. And here's a summary of many places where you see it. You see it in transitions in evolution, and I'm going to show an example of that. You see it in brain sensory processing. Everybody's familiar with decibels. The auditory scale is logarithmic, or basically, factors of 10, right? It's much louder at 100 decibels than it is at 50. I guess it's 10 to the 5th, right? And then for your visual processing, there's also a scale, a log scale. That's called Weber-Fechner scale. So the human eye can detect over many orders of magnitude light intensity, and under very controlled laboratory conditions, the human eye can even detect a single photon. Earthquake sequences, we mentioned, log power law, and shell snowflake spirals follow log spirals. I show here the log spiral for the spiral arms in a galaxy. And of course, there's some limit based on the size of the galaxy, but it extends out for quite a while in the optical. And if you measure in radio frequencies, you find that the arms can go even twice as far as what you see in the optical. And of course, here we're going to focus in on financial bubbles and their log periodic nature. Okay, so this example is for logarithmic time. It comes from his chapter 6. And this uses evolution as the example with the uniform ratio between events. And the idea is that evolution proceeds faster and faster. And so this table or chart is marked off in millions of years. And if we go down to the bottom, the origin of life 3,300 million years ago, a little over 3 billion years. And then the first kind of complex cells, 1,800 billion years ago, multicellular, a billion, and other major steps. And here the major steps have been marked by tick marks, and then the black dots are a fit to some sort of regular log periodic time. So you can see that the black dots are lining up pretty well with the tick marks. And what I've done is I've shown you the differences here. So the first difference is 1,500 million years, and then it's 800, and then it's 430, and then it's 240 and 140. So you're seeing that it's almost cutting in half, right? It's a little less than a factor of 2 from each step to the next. And then if you go over into the leftmost branch, that's dinosaurs, that's theropods. It includes the T-Rex and the Velociraptor. And there you've seen that the intervals go from 46 to 23 to 11 to 5. So they're really just being cut in half. So in this context, he calls it a G value. It's like the lambda value that we're going to introduce in a bit. But if you're cutting a factor of 2 for each key event for the duration or the interval to the next key event, then that's a G of 2. Here it was 2.02. And then primates are up there near the middle, a little bit on the right side, where it says 62, 35, 19. And primates have a G value of 1.73, but also adhere to this. And the last major one was, 300,000 years ago for modern man. By the way, you may be curious when the thing terminates. We have another 2 million years, according to this. But you see marked on each of these branches or this TC, and that's the critical time. And that's when it reaches a major extinction event or major change of some sort. So we see that for that particular branch of dinosaurs, it was 140 million years ago. And for primates, fortunately, it's in the future.
What is supposed to be happening 2 million years from now?
I don't know. And clearly a lot of things are going on, in the short term in terms of AI and robotics and
Right.
genetic medicine that are accelerating everything. So I don't know what's supposed to happen. You have to ask the.
But I love this logarithmic time idea, right? It's the time where Bitcoin lives in. Bitcoin thinks in logarithmic time, right?
Logarithmic time. Well, there are two ways to look at logarithmic time. One is our core, long-term power law.
Yeah.
And so it's taking, longer and longer to double, but it's still very rapid. It's a 2-year double. And then the other is what happens in these bubbles. And the bubbles have, and you can look at bubbles in terms of log price or price if you've got a relatively short interval, like a year or two. And they have this sort of typical power law component, which is the B term in this equation, but it's taking the difference between the current time and the critical time in the future. So TC is in the future, T is whatever the time is now, the difference is a positive number, you raise it to a power M. And so that's kind of a base power law construct. And in the log periodic power law relationship, normally that M is less than 1. So it's usually in a range like a half or 1, something like that. So you have kind of a calibration term, which is the A term, and then you have that kind of linear power law term, but then you have this very important periodic nature, which is this term that I have the oval around, the cosine term. So it's got this kind of leading parallel component, but we're going to focus on the omega, that thing that looks like a little W, and the critical time T sub C, and M is this power law slope. So the overall idea is that you have this uptrend slope of power law index M that's decorated, as he calls it, with oscillations, and those oscillations get closer and closer in this kind of logarithmic fashion, log time fashion that we just saw in the prior chart in that evolutionary case. Okay, so let's try to make this omega less mysterious, because that's what tells you how rapidly the oscillations come. It's an angular frequency parameter. It's related to the scaling factor of time between the peaks. We just saw that as a G. This lambda is essentially the equivalent of that. And remember, those G's were like 1.7 and 2. And here's the relationship. There's an exponential in there because we're dealing in logarithms. So lambda is like a logarithmic wavelength, but in time, of that time interval, not a spatial wavelength. And it's related to omega by this 2 pi over omega ratio, as an exponential of that. So the time ratio for oscillations is 1 over lambda. If lambda is 2, then the time is being cut in half for each one. So for example, if the first and second oscillations were 100 days apart, then the second and third peaks should be about 50 days apart, and the third and fourth should be about 25 days apart. And you can see this is kind of like Zeno's paradox, right? Where you're adding 100 plus 50 plus 25, you're cutting it in half. It's all going to sum up to 200 in the limit, which is lambda times, the 100 days. And in terms of omega, a lambda value of 2 corresponds to an omega of 9, because you plug into this equation, you just rearrange it. Omega is 2 pi divided by the natural log of lambda. I had done a fit before for Bitcoin, and for that fit done some weeks ago, I said omega was 8.1, and so that would correspond to a lambda that's, when omega is a little lower than 9, then lambda is going to be a little higher, maybe 2.1, 2.2, something like that. And at that time, it was saying a critical time around the end of August. Okay, we're going to update that. So here's that table. So for lambda of 1.5 or 2 or 2.5, 3, omega falls from 15 to 9 to about 7 to a little under 6. And the total time, if the first interval, say, were 100 days, then the total time would be 300 or 200. Or if lambda is 3, it would only be 150 days. It would be quite rapid. The number of oscillations is also roughly similar to the omega parameter. It turns out to be 12 if omega is 15.5, and 7 if omega is 9. And actually, the number of oscillations is even higher than this, but I kind of cutting off to a 1-day minimum oscillation, but you'd still get oscillations in the hourly time scale and shorter as you go to the critical value. But you can see this rough correspondence between the omega and the number of oscillations of at least 1 day duration. Okay, and then directly from his book, chapter 7 on stocks and forex, 3 cases: the Dow Jones in the 1920s with the big crash in 1929. So this is really the full decade almost of the 1920s. And for that, he measured omega of 5, and his critical time was 1929.8, which you can think of as being basically October, right, of 1929 when their crash happened. Here's the big crash in 1987, which Giovanni and I remember. Many of you younger than that won't remember, but it was quite a big crash, but then the stock market went on to recover from it. 1987, it had an omega 7.4, so it was more rapid oscillations. And this is showing over a little 2.5 year period, the data. He found M slope of 0.33 and omega 7.4, and the critical time was, I'm not seeing it, late in, 87.65, which is 2/3 of the way through 1987, which took us roughly to October. And then the third one is a foreign exchange, both for the dollar, both against the Canadian dollar and the yen. And there, the omegas were slightly different, 8.2 and 7.2. This was all a fallout from the Asian financial crisis in 1997, which extended to Russia in 1998, and the big collapse of long-term capital management, they were leveraged 100 to 1 on Russian bonds. And so that was a big collapse of a hedge fund that had two Nobel Prize winners who were inventors of the Black-Scholes formula for option pricing. And there's other sorts of risks besides price risk and market risk. There's credit risk, and so the counterparty risk was not accounted for, and they got wiped out. But the peak for this one in the foreign exchange market was towards the end of 1998. With those two values of omega. So it can work in multiple markets. And this table shows many other market cases. Several of them are currencies. A number of them are, financial stock market indices, such as the two I showed you, and some others from Hong Kong and elsewhere. He also has a couple of individual stocks, IBM and P&G. He has the NASDAQ 2000 bubble up. And you can see that the omegas all sit in between 5.2 and 8.2 as a range. And therefore, the lambdas are all in the range of 2.2, 3.4. Even though the drops are quite different. The drops can be small, around 19, 20%, or they can be major, exceeding even 50%. And here's Sornet's analysis of Bitcoin in 2018. And in particular, the two largest bubbles that he was able to look at were the 2013 and 2017 bubbles. The left-hand side of this figure shows the market to Metcalfe ratio. So he had basically done a Metcalfe's law kind of analysis with addresses. So he did some kind of power law with the addresses. And so he's looking at the market multiple relative to that. And the two we're most interested are the two blue colors. So the dark blue is 2013 and the light blue is 2017. And then if you look in the right-hand chart, you see the log periodic power law fits to those, and you can see the waves drawn in. Those are the model waves, but they match, the data pretty well. And then he scaled everything to some kind of uniform time when it gets to T critical, which would be 1 here. And, pretty good fit, extending over quite a few bubbles in each case, a little better for the 2017 than for the 2013. And the respective omegas were 9.0 and 12.0. So how many oscillations? I actually
did you try to update it with the last bubble, because he doesn't have a last bubble?
Yeah. No, I've got the anti-bubble from the last bubble, and I'm going to show you. And I've got our current bubble prospects.
What about the bubble itself? What about the bubble itself?
This one shows that, actually. So I asked ChatGPT how many log periodic oscillations were in these bubbles. So 2011, there were 5 to 6, and this is like a cutoff of a 1-day minimum size. 2013, 6 to 8. 2017, 7 to 10. And it has some comments about how well structured they were. But really, all three of those were pretty well structured. And then the last one, the 2021, which was a double bubble. So it was 4 to 6 per sub bubble. So it was really 8 to 12 overall. And Also, though, it noted that the combined behavior may not fit classic LPPL cleanly. So we are seeing some diffusion, but the thing to take away from the general trend here was that omega's going up. It went up from roughly 5 to roughly 10 or so. And that means that, of course, that lambda is getting smaller. So the number of oscillations is rising and disorder is increasing even as the bubble power lessens. Okay, now let's compare this to the approximate entropy calculations that I've showed you before. And here it's especially noticeable in the price, but it's also noticeable in the residuals, which is the green line. So the smaller chart in the lower right with the white background has the price in blue. And this is not price, it's the approximate entropy calculated from price and using a 104-week rolling filter. And also the power law detrended is the green. And we can see both of those have a rising trend. A lot of oscillation, but a rising trend, particularly clear in the price. So we've talked a bit about why we think that's going on, that disorder is increasing even as the bubble power lessens. And this count of the number of log periodic oscillations is consistent. The number of oscillations is rising at the same time that the baseline entropy is also rising. Low entropy corresponds to few oscillations, right? So as that rises, that means higher frequency. All right, here is a model for the anti-bubble of 2018, a reasonably good fit. These are all, I'm trying to think, these are all, okay, so this was a question to ChatGPT about the declines, the crashes, the anti-bubbles. And so it said there was strong case for the 2011 downside, after 2013 peak in December 2013, and after 2017, it called probable. And so in the chart, I've done a fit for the downside from 2017. So it's basically during the year 2018. It's a pretty good fit. And I'm going to show you the next one, the latest one, which was the 2022. So this is the anti-bubble of 2022. The peak was mid-November of 2021. And so I carried it through the end of 2022. And actually, that's when the price turned around at around 15, 16,000, and it's been rising, ever since. And here the omega fit is 7.5. The R squared is very good. It's 0.96. Although visually it doesn't look all that great. But as an overall trend, it works reasonably well. All right. And where are we now? So this is the Bitcoin bubble of 2024, 2025. I'm using 2.5 years of data and log periodic power law forecast. And I've done it both for log price and for price. The formula I showed you before, many slides back, wrote log price, but you can just take the same formula and use price and apply it there. And for shorter time periods, it's not a huge difference, but it's good to run them both and compare them and see if they're consistent. And they're pretty consistent. So what we find is that with price, which is the right-hand chart, our omega is 8.5, and with log price, the left-hand chart, our omega is 7.95. The R squareds are the same. It's 0.958 for one and 0.953 for the other. They're both very good. Their critical dates are similar. So the critical time with price is September 23rd of this year, and with log price, September 3rd. And note on the log price that that's a natural log scale. So that's why you're seeing numbers like 10 and 11 there. So that's e to some power. Okay, so at critical, things go crazy. And basically, the critical date is the most likely, but statistically it's the case that the crashes would happen sooner rather than later, although they can happen either sooner or later. So you ask it, what's going to be the price, say, a week prior? And it's predicting 129,000 a week prior. And so this was why I was interested to see your tweet, Giovanni, that said, well, maybe just taking the daily percentage return average, it looks like we may be headed towards 125K late in the year. Here's a summary of what
in fact, I was and I was discussing with a group of people. It's a kind of high-level discussion group that I'm having with Minotaur, and we were talking about this stuff, and they were saying, "Oh, I need to ask Steven if he did an update because I want to compare my rough calculation with the log periodic power law." we really tried the mind.
We're really synchronized here. Yeah.
Yes.
So basically, we have peaks according to the model best fit, although the actual peaks are not that different. The peak oscillations were last year, April 6th, January 11th of this year, and the third one was a little over a month ago, May 24th. And in duration between the first two and the second two are respectively 280 days and 133, with an omega. I don't know why this one says 8.44. It's slightly different, but lambda. Oh, that's because I just took that ratio, 280 to 133. That gives you a lambda of 2.1. And then if you compute the omega, it's 8.44. And it agrees well with the 8.55. That's the point there. And so you can say, when would the next peak be? Well, it would be a 65-day duration. That puts it in July 26. So a couple of weeks off, huh? And estimated price, 121K, according to the model. And then the peak after that would be another month, and end of August, and that would be 125K kind of level.
Sorry, I'm still not sure about that.
I woke up Siri. She got excited. Excuse me. Okay, and in terms of price levels,
you have something with the AIs. We really like you have a strong relationship.
Competing AIs.
Asking for your attention.
Okay. So the price levels, the April 6th actual peak, April 6th of 2024, actual peak 69,000. The log periodic power law fit was 65,000, so that was 5% different. The one in January, almost 95,000. LPPL, almost 94,000, different by only 1%. And then the one in May, 108,000. The LPPL said 111,000, which is where we are today, and that was 3% different. And then we're looking at 121,000 later this month. So here I've stripped off the price data so you can see the forecast more clearly and see how the oscillations are squeezed again. Now, there's also something called the Shanks transform that he mentions, actually not in chapter 7, but in chapter 9 of his book. And what you can do is you can take the first three peaks and then you can calculate, when the next peaks are going to be. And you can also calculate the critical time. So the formula for the critical time is if you have three peaks, you take the mid time measured from whatever your 0 point was, which was normally going to be, the start of the rise. So in this case, the beginning of 2023. So it's the number of days from 2023 to the middle peak. You square it, and then you subtract the product of the first and the last. That's your numerator, and then your denominator is 2 times, the day count for the mid peak, and then subtract the first day count and the third day count. So this is because of the logarithmic relationship, and then that gives you a projection for the critical time. And that actually yields September 22nd on the peaks fit with the LPPL. And if you take the actual peak occurrences when they happened, it says September 1st. So rough correspondence is good there. All right. And then I asked, well, what if I just use a little bit less data? How much does it change? Just trying to judge the sensitivity starting from 2024 January. And here omega was 8.5. The R squared was lower because I had less data, 0.89. But the critical time was consistent September 14th, and the peak projection consistent, roughly around 125K, 123K for, I think, a week or two before. Yeah, 2 weeks before, I think. Okay, that is it. Thank you very much.
Very good. That was really cool. Yeah. So, is there a way of understanding how the long-term power law and this log periodic power law fit together? What is a picture? Are they two different phenomena, or they are related to each other somehow?
Well, these bubbles ride on the back of the sandworm, which is the core power law, right?
Right.
And
did you ever try? I think you tried one time, right, to look at the entire process and see if you could find a log periodic power law that every oscillation of. But you know what? Actually, I tried the first time, right? Because if you look at the first 3 bubbles, you could fit a log periodic power law because
I did that. Yeah.
Right, you tried that.
Yeah, I tried to fit 4 and I couldn't. I could fit them pairwise, 2 at a time.
Because I could fit the first 3. No, I didn't do it super formal way. What I did, I didn't calculate the full methodology. What I did, because with the first 3 bubbles, right, the first one, because this is what you are expecting, right? You're expecting that. Actually, you know what? Actually, I'm taking back because I'm trying to think what I was thinking about this phenomena. So you will expect, right, if these bubbles were themselves, right, these faster and faster oscillations that we're expecting from the log periodic power law, we should see the time in between the peaks becoming smaller, right? And instead, initially, if we focus on the first 3 bubbles, because I was actually distracted by this, and I made a model where I noticed that the time in between the first bubble, that is the bubble, including the bubble before the halving. So if you really include all the bubbles, even the one in 2010 that happened before the halving, the time between that bubble and the next one was shorter, was about 2 years. And then it took 4 years. So when I look at that, I thought, maybe these long-term type of bubble, they do the opposite of the short oscillations. The short-term oscillation, they seem to accelerate. Maybe these bubbles decelerate, but we are still log periodic, right? So I made a model where instead of making them accelerate, I make them decelerate, right? But using a log periodic, some kind of oscillation, but one that slows down instead of us going faster. Yeah.
I'm going to share a slide. I'm going to share a slide because what I found was the way to tie these things together was to look
Right.
at how the power law index was changing with time, and then you could fit the log periodic power law model to that, to the
I
index of the
see.
core power law.
Ah,
So let me share that because okay. So in the upper chart, I have what you would calculate the power slope to be, power law slope to be at any given time. Now, I did this in block years, and we should redo it in calendar years. But you see that there are these bubbles in the power law slope, right? Just as you would expect, that it gets larger, stronger when you have a bubble in the price. But then they're also attenuating, and it flattened out, to be between 5 and 6. So the lower chart is a fit of the log periodic power law to the first 3 peaks of the chart above. And it's a pretty good fit. Yeah.
What is the interpretation of that? What do you think it means?
I don't know. We need to think harder.
Yeah, we need to
It's
look
not
it
it's
up.
not perfect. It's got this bounce, right? And but there's some underlying fundamental dynamics, right, of how this power law is trying to lock in, and then it locks itself in during the first, say, 8 years, 7 years, whatever.
Mm-hmm.
And I think that's kind of manifesting itself here.
Really cool. We need to investigate this deeper. It
Yeah.
seems very interesting, very relevant. Yeah, I like it. Okay. All right, very good. So even when we just do review, we still present a new interesting results that were never discovered before. So one of the reasons why to see this show, because we usually present novel research, about things that people never saw in Bitcoin before. Anyway, okay, so we'll switch. We can answer questions in the end. So please, if you have any question about Steven's presentation, let us know. I'm going to do my presentation. Back here. Okay. Last time I did something right that seemed to work. Right? Was it better when?
Yeah, it was better last time.
I don't know. What about these? No.
Can
Not
you, if you can take away or make smaller the ones on the side, would help a little bit.
Like this? Better?
Yeah, that's better.
Okay. All right. So I'm going to talk briefly about 2 topics. One is this. I continue this exploration of the relationship between social media and the price of Bitcoin. This is something that I already talked in the past, right? So if you look at Google, this thing called Google Interest Index is basically it's like some kind of normalized measure of number of searches. I wish we had like more of a rough measure instead of normalizing it. But if you take it as it is, basically you look at this relative measure of interest in Bitcoin through Google searches is strongly correlated to Bitcoin in a power law. And the power law actually is 1.85. It is very close to Metcalfe, right? N equal 2. So this is not a new result. I already showed this before. And you can actually make a model of these. These are also shown in one of the previous episodes. the correlation is pretty good, 0.89. I think it's a more update value. It's 1.95 versus close to 2. And you can make then a model of a price of Bitcoin. Now the question is the price driving the Google searches, or the Google searches drive the price? Probably is a feedback loop, like in all these things. There is some initial interest that drives the price, and then the price brings most. And you can see, for example, during the bubbles, the searches spike, right? And in fact, they basically get decoupled from this power law. They make their own. Basically, that is the definition of FOMO itself. Now, it's interesting that we have right now, if you're looking at the recent data, we have kind of a decline of this value. The coupling seems to be lost, right? Usually, when we are not in a bubble, we are still, the red curve is still above, kind of tracking pretty well the black one. The directionality is still there, but it's lower than the price itself. So it's almost like there is some loss of interest in the social media, or the price is bigger than what the social media interest looks like. So it's something that needs to be explored, but it's very interesting to look at these metrics, right? These are a further indication that the price discovery of Bitcoin doesn't happen only on the market, but is happening also on social media. So it's a real network effect. Now, the new result is that I look at some other social media data that is subreddit. So there is a very popular, I think it's several million people that are subscribe to this Reddit subreddit called Bitcoin. There are a few others, but this is the most popular one. So I track these subreddit subscriptions, and I track it. I plot it in a log graph relative to the price, other power law. Now, it's interesting that this power law, it's as a power that is smaller, 1.28. That requires some interpretation. This will mean that it takes many more subscriptions for the price to go up relatively to Google searches. It's less reactive, but it's also smoother. Also, we have like usually these Google searches data, you get an update every month. Here you can actually track it day by day, so you have more data. And if you make a model, you get a smoother model of a price. It's also the subreddit values are underestimating the price right now. The price is much higher, but I like this model because it's very smooth. It does react to the bubbles, but then it's kind of, because it starts to react early, right? Maybe with some delay, but it doesn't really drop too much. It's not a spike like you see with Google searches, because probably these people, even after the bubble, they continue to stay subscribed, right? They don't leave. Maybe people start to do less searches after the peak, but the subscriptions stay there. So it's interesting that, again, we found another indication of some kind of social media activity that strongly correlates in a power law fashion, like this expected from network, with Bitcoin. So I'm going to look for other. It would be nice to get X data. I don't know how to extract that X data. I was able to extract this information, but it will be also interesting to look at other social media. So yeah, this is an interesting result. Do you have any comment on this, Stephen?
No, I mean, I think it's expected. I think if you consider Reddit relative to Google, that the Reddit people are more like whales, and we know that we do the power laws with the number of addresses, that it's a lower index for the whales. So that would be my thinking there.
Yeah,
they're I mean, I'm not saying the average Reddit user is a whale, but they're likely to hold more Bitcoin than the average person doing a Google search,
yeah,
who is
correct.
mostly, newbies, right? Or potential
Right.
newbies.
And and so right now we have at least three different social network, right? So we have Google, we have Reddit, and then addresses, right? Addresses, of course, is more relevant and more directly connected to Bitcoin, but it's interesting that three different social networks all form power laws. So this makes a very, very strong case that it's a network effect. The price is more driven by network effect. That market, it's not just maybe supply and demand can determine the price day by day, but the long-term trajectory is more of a social phenomena than anything else. Will you agree with that conclusion? Is a very strong evidence in three different networks that all kind of point in the same direction. Anyway, so the other thing I looked, this again not completely new. Think about, in fact, I think Sornet in one of his papers actually shows a graph like this, right? He has a paper where he looks at the holding time of investor, and even that holding time is a power law. So as far as Sornet wrote three different papers on Bitcoin, and one of them has a graph like this. So what I'm showing here is basically the amount of Bitcoin. So the scale is not comparable. It's a price, correctly priced for Bitcoin. The usual familiar curve that everybody knows. In a log linear chart, and then I'm showing the kind of normalized to make it easier to compare with the price of Bitcoin. And this is basically the holding. I am in the middle of this investigation, so these are just explorative graphs. But because he himself plotted these, but they wanted to reproduce and also update. Basically, and there are people use different. I found, by the way, I will share it with you later. I found a very cheap source of on-chain data because, for example, CoinGlass is prohibitive. It's actually, I know that it's a business and they are trying to sustain their business, but they are literally charging $10,000 a year or something like that to actually download the data. And I hope this new source lasts, but you can get basically almost all the on-chain data for only a few $100s a month. So I will share it with you later, Steve. It's a very good source. But anyway, in fact, actually, yeah, like everybody should know about these. It's called. Anybody's interested? Let me find it. It's called a New Age. New Age. Let me write it here somewhere. Let me do this. I will actually show next episode. I will make a presentation about this because it's nice actually when more people give them business, and I want to show you all the different data. So I will make a presentation next episode about this. I'm always looking for sources of data, and CoinGlass has been like one of the most rich sources, unless somebody learns how to program and get the data directly from the chain. So there are a few providers, and CoinGlass one of them. But there is a new one that I just found. I think they are recent. I never saw them before. So I will make a presentation about them next time. But I took this from their definition of long-term older supply. And basically, we are looking at addresses that have kept the coins um, for at least 150 days, 155 days. So it's an arbitrary definition, right? Anybody could make different definition. It could be 1 year, 2 years, 4 years, but this, 155 days. This is what to them defines a long-term holder or more, right? And so, yeah. So if you take these as your definition, then you get the black curve. And so what is and there are probably better way of showing this graph by normalizing it, etc. So I'm going to work on this. But this is, I remember this graph from Sornet paper. He had exactly the same paper. And you can see they are basically kind of the opposite of each other, right? When the black curve is long-term, and the red one is short term. And short term, this means basically the ones that are keeping less than 5 months, right? This is what defines them short term. And you see they are kind of almost complementary each other, right? When you see a peak here, there is a low here. It has to be because basically if you sum them together, they give you the total supply, right? So one has to be manual. This is why probably will have been better to use a different definition, like one maybe 3 years and the other one really short. But this is what the data that we have. But what is interesting though is that during a peak, the long term start to decrease. They sell. So the long-term people, they held Bitcoin, they probably realize a gain, and they start to sell. So that is kind of something that is not trivial, right? Many people will not expect that. They will expect the long-term investor being the ones that are actually holding Bitcoin the longest. Now, this needs to be studied better. Do they buy at the bottom? Do they go back, right? Because of course, this total number goes up. Or these are new people that now they became long-term investors, right? Or maybe it's a mixture. So there are all kinds of different cases. It would be nice to separate. I don't know if this is from the data that we are getting. The ultimate thing, for people like me and Steven that are trying to go deeper and deeper in these things. So Steven, part of the institute will be to actually hire people that can go directly to the on-chain data and then pull out whatever information we want, right? Because usually using this third party, they have already packaged information, right? You can get, like here, for example, you can just get long-term and short-term, right? But if you want to change the definition of what long-term is, you don't have that option. But if we add our own codes, where we say, okay, now let's filter these, right? Let's get these data versus this other data. So really to do this in a more serious fashion and go deeper, we will need to program our own way of selecting the data from the chain. And that is one of the things that the Institute will do. We will have to hire a team to do that. I don't think it's completely trivial. Did you ever try to learn how to extract information directly from the chain, Steven?
No, I have not.
Yeah, that would be.
Yeah, Sornet divided things into 3 categories. So he had short, medium, and long term, but showed the same basic result. And he did show that the long term did acquire additional Bitcoin when the price slumped. So they did come back in as buyers. And I think you see it here. You see it here too.
Yeah, it's something that we need to go deeper. But we need. My dream is to have a way of selecting whatever information I want, according to particular criteria. And right now, if you use third parties, data providers, they don't allow you to do that. But yeah, you were commenting. You were saying.
No, I mean, I can see it. I can see that they are buying as the price is in the slump.
Right.
Black line is
Because the
growing.
line goes back, right? But it could be new people though, right? But now they have they bought long time ago, and now they
Right.
qualify.
Yeah, one would have to look at the addresses to see.
Yeah. It's we need to go deeper in the data. But the other thing I try to do is to see if there is any correlation with price. This is what I get. This is a log linear chart. I try both log and log linear. It's not clear there is a very precise. I mean, this kind of suggests almost exponential, right? Because you kind of see kind of almost like a straight line going through. I'm still trying to model this. I will report next time. But the first observation in general, the long-term holders are correlated with price, right? There is some correlation. Maybe it's not a simple exponential, not a power law, but some kind of correlation. Also, this going back and forth, this is what we were showing before, right? They sell, so they became less. So this is what it means, right? When we have a peak, if you go in this direction, if you go backwards relatively to the price, so the price is going up, but the number of long-term holder decreases, right? Is what he says. And then it goes up again, but it stays flat most of the time. Most of the action actually happens in the bubbles, It's interesting. But the long-term trajectory, it's correlated, right? It's kind of, we know it. This shows adoptions. It shows that over a long period of time, more and more people are keeping their Bitcoin long term. Maybe it's not necessarily the same people, but indicates by that the growth of the price is correlated with this idea of being long-term investors, while the short-term investors they were kind of correlated initially a little bit. Also because probably it was difficult to distinguish short-term and long-term, right, initially. But then now the fact that the price goes up and it stays, it doesn't go anywhere, it means that they are not correlated, right? They come and go, they come and go. They don't have anything to do with how the price evolves. This is, I think it's an important observation, right? So this is what drives the price, this doesn't drive the price. Seems obvious, but again, if it was only supply and demand and just market activity and speculation, you will think the speculators want to come in and go out, right? Come in and go out. But it shows here that this is why it would be also nice to see different amounts, right? Different amounts of holding and doing it in a very fine fashion, right? Making that definition of long-term longer and longer, and see how this graph evolves with longer and longer term. But something that we'll see if I have a data somehow, maybe indirectly, but eventually, we need to extract this information ourselves. But I like this graph, right? This is.
There's a lot going on here. It's amazing how you can see the three bubbles, and even the 2011 one, the 2013, 2021, right, and how they interact with the short term, and you can see the decay.
Next thing is actually to plot one versus the other, right? So plotting one quantity versus the other one, short term versus long term. And I want to do also different amounts, right? Like how they interact with each other, like large wallets versus small wallets. Well, we can do that next time. Okay, these are just exploratory graphs so far, but this is what I'm investigating at the moment. Okay, so we can go and take some questions. If I go back here. All right, so we have some question. First of all, this one. Does Monio Depp have a YouTube channel? He has an X account. And he has also
I have a YouTube channel, and it's under my name, Stephen Perrenod, Perrenod.
We both have he has a Substack and I have a Medium. So a lot of Stephen writes a lot of articles. So if you want to explore more of his work, and also please, his name is your name on X is Money or Debt, right?
Correct.
So yeah, please subscribe to him. All right, and then. So these, I guess, is for me. Did you invent the power law? Well, the power law in general. Who invented the power law? Who discovered? I don't know. Maybe you can say Kepler was one of the first people that observed a law of nature following a power law. At that time, they kind of were the real definition of log actually came later. In fact, actually, that could be a presentation, one of these episodes, the history of logarithm and how they crept in understanding science. But it's a very interesting story because basically Kepler was looking for an explanation of the motion of the planets because it was during the Renaissance when people went back, to think that there was logic, there was math beyond the universe. It was not just miracles. The universe was now driven by miracles, and he was trying all kind of things, mostly some of these very exoteric things that were associated with math at that time, all these Platonic solid, all kind of things, and nothing worked. And it happened to be that people started to kind of edging slowly towards this concept of powers and logs. And he actually contributed, Kepler himself contributed to this understanding. They didn't have a way of graphing it because that I made actually this mistake, I think, in a couple of interviews. I say, and Kepler at a certain point, he made a drawing of the log of a distance of a planet versus the log of a orbital period. And it was a mistake because actually that graph ability as a technology didn't come about for another century. It was created by Descartes. Descartes came up with this idea of basically being able to draw equations on a piece of paper. It was a genius idea. We give it for granted, but it was very revolutionary, right? So he will not be able to draw, but he did have a calculation of basically the equivalent of a log of a distance of a planet versus the log of a time to the planet, and he saw that there was a pattern. There was a linear relationship between these. Imagine how crazy it was, right, to do all this calculation by hand, pages and pages and pages of calculations. But so he was probably one of the first people. In terms of the power law in Bitcoin, I think I am the first one that came up with the terminology of the power law. Now, there was one person that I call him the grandfather of the power law. His name is Trollol Law, and he made, so there was this basically, how will you call it, board, bulletin board or whatever, where Satoshi himself contributed. It was not like a social media like we know right now, right? People basically posted things, and you can find it in this web page, right? And this guy made a post where he basically kind of tried to fit the growth of Bitcoin through some kind of logarithmic fit, but he was getting some kind of a formula that, if you go backwards and you actually elaborate it, it's very similar to the power law. But the true discovery of a power law is that recognizing it as a power law, and because once you recognize it as a power law, it's not just a model, it's a worldview. It's pointing out, and you needed a physicist to do that. You needed to point out the fact that you had the scaling properties, that Bitcoin is a scaling phenomena, and then you put it in this context. And I started to do that since 2000. 13 to point. In fact, some of the first power laws that I found were between price and addresses, price and transactions, uh, and later price and time. But yeah, I think I was one of the first people to find this scaling behavior in Bitcoin and pointing out its relevance, because that to me is even more important than just making a model. A model, oh, okay, these things seem to fit this, but what does it mean? It means that it's a scaling phenomenon. But if you are a physicist, it is a big, big deal. So yes, but it doesn't matter, right? The important thing is that we recognize this idea and we are working on it, and we are bringing more and more people are recognizing it, like Stephen. How did you come to the power law, Stephen? I think you told me a couple of times. I just
Yeah, it was 5 years ago. It was in 2019, and I saw the tweet from H.C. Berger
Mhm.
in Europe, and he talked about it in somewhat general terms. But then I started modeling with the power law, and then I only, learned about your discovery, less than 2 years ago, right?
Yeah.
Over a year ago, but less than 2
H.C.
years.
Berger saw my post in 2018, and he thought I was crazy because I was showing this straight line. That is the other thing. Showing
Mhm.
the price as a straight line is very striking, and he thought it was like a mistake. This what he actually says this in some of his. He was interviewed, and this is what he said. I actually got mad at that guy that was drawing this straight line because I thought he didn't know what he was doing. And then I noticed his name on Reddit is Econophysicist One. So maybe the guy knew what he was doing, and then he reproduced it and he said, "Whoa!" And he literally said this, that once he discovered it, he thought is everybody should show the power law only in a log-log graph, because you immediately realize what you're looking at. That is something extraordinary. And he said, that is the only way to show the power law. Everybody else showing it in other way, it's a waste of time. Should always be shown in a log-log graph, and people should start to learn how to read this log-log graph. But yeah, that was very cool. So, and probably this is also for me, but you're welcome to. Yeah, I like. I don't want to trade spot, because unless it's just simply DCAing, and so buying Bitcoin and trying to DCA, that is a form of trading too. When you buy a little bit of Bitcoin over time. But yeah, I do have this trading system that is using futures, and the reason of using futures is that you can use your Bitcoin as a collateral, and so you don't have to sell or your Bitcoin. Okay, I found this channel. Thanks for your work. You're welcome. My question: has a power law been found in some relation with any other commodity? Well, tonight, and Stephen can answer that, but locally you can find power laws, right? That is what um, what Sornet says, that near this critical phenomena, because actually that is a very interesting idea, right? That we see in nature many critical phenomena. Like, for example, one that I can describe is when water goes from liquid to ice. You see a lot of power law. For example, in this case, when you have this phase transition, we call this critical phenomena. There is a critical temperature that is reached, something dramatic happens. Ice changes, right? The question is, what happens if you are very, very close? You are close to that temperature, or you are slowly transitioning to that temperature, right? What happens just before you reach that temperature? One of the things you notice, if you were able to focus inside the ice, right, you will see organization of pieces of ice, blocks of ice. They go from being basically few molecules together, always to chunks of ice that you can see with your eyes, uh, with your naked eyes. Now, if you organize these chunks in terms of how many of them there are with a given size, and you do a log-log graph, right? You have log of size on the x-axis and log of number of these chunks with a given size, guess what? You get a power law. So they come up as many different parameters, how the parameters of these critical phenomena organize themselves. And this is just an example during these transition phases, these critical event. And this is the entire thesis of Sornet, because his idea is that these antibubbles or bubbles are this kind of, in spirit, is almost like a phase transition. You go from one state to another state very, very fast. This is why I use this word critical, right? The critical point. And you will expect, if these physical phenomena are universal, to see something similar. In fact, the power laws show up in the behavior of the price itself. The price itself start to tend to be like a power law. On top of that, you get another oscillation. And this oscillation, it turns out that actually, by the way, a power law, this is an exotic thing that I don't still understand it myself, but I want to explore it. It turns out that an exponent that is imaginary, that is a complex number, right? I told you this before, Stephen. I don't know if you thought much about this, but it turns out that if an exponent of a power law is complex, then it gives rise to these faster and faster oscillations. So it is basically, it's two power laws. The oscillations is one power law, and the overall trend is another power law. So yes, locally you can have this power law behavior that gives rise to this log periodic power law, but it's basically two power laws, one with a real exponent and the other one with a complex exponent, complex number exponent, that is a real number plus an imaginary number. It's really something to think about, right? What that means. But yes, locally you can have. Now, I don't know of any financial asset that looks like a power law over 8 order of magnitudes. There is not, because most of the other assets that we are familiar with, that are SP 500, gold, silver, Nasdaq, there are, and even the supply, the money supply, M2, they're all exponential over the long period of time. And they are exponential because they are associated with exponential processes, right? Basically, like inflation, GDP, where you have a rate of growth of this phenomena that is constant in time, or roughly constant in time. And this gives rise to exponential. And we have pointed out many times that these exponentials are not sustainable. So all these processes are not sustainable, while power laws are sustainable. They can last for a long, long period of time. The growth of cities, the GDP in a city is a power law. So yeah, and Bitcoin, as far as I know, is the only phenomena that works like a power law over a long period of time. The only one. Okay. I'm recently using on-chain analytics for supply of stable coins instead of M2 as a correlation to BT sprite. The wrestling seems not require an offset. Okay, if you want to DM me and explain what you're doing, I will be interested in looking into it. So maybe you can DM me and discuss this with me. I think a lot. Okay, Stephen came back. So do you want to say anything about this? Have you ever looked at these instead of using M2, looking at the supply?
Stable coins? Well, my only thinking is that stable coins is very small relative to M2. Money would flow from M2 into stable coins, and then it may or may not flow into Bitcoin, right?
Right.
Some people hold stable coins just as an alternative to the dollar. I think what really matters is M2 plus stable coins.
Yeah. But it's something that we can look into and understand better. Anyway, guys, I think this covers all the questions. Oh, maybe this one. I think we didn't answer this one.
That one, yeah. Yeah, the two the two are in disagreement at this point. So the forecast that gets you to 175K to 200K range are based on historical volatility, right? And but also the decaying of bubble strength. So you combine those two, and you can get, using the historical standard deviation or volatility, then you can get numbers up there. So those forecasts are in disagreement right now with what the LPPL projection is showing. What's your comment, Giovanni,
So
on
one
that?
way of thinking about this, right? And I was actually discussing this with this dedicated group. What we tend to do with this analysis, right, is taking any type of regularity in Bitcoin and then extrapolate this regularity, right? Because really is the only thing we can do. Because anybody else, right? If this person say, Sailor just mentioned that Bitcoin is going to do 300,000 this cycle. Based on what? His feelings. In the end, is his feelings. Unless he explains step by step the logic that he followed, right? And then you can trust that logic because at least the parameters, right? So even if the Bitcoin doesn't do exactly what is predicted, then why it didn't, because maybe one of these premises or starting point didn't follow through. But at least what to expect if these parameters continue to behave in the same way, right? So, for example, this extrapolation to 200K, Stephen has said, there are many ways of arriving to the same number, but one simple way, you calculate the deviations from the power law, and then you plot them in a log chart, in a log linear chart, and you see the peaks are more or less aligned in a straight line. That suggests that it looks like, at least until now, Bitcoin peaks follow some kind of an exponential decay. In fact, you could have used the first three peaks to kind of predict the fourth one within a few $1,000s. So it's not an imaginary thing. It's not invented. Bitcoin has done that so far. Now, one can say, if this pattern continues, then this is what to expect. But you see, it's precise, right? And giving you the premise. And then if we observe something different, right, we can compare what actually happens to what is predicted, right? It's more like, when you do these long seasonal predictions of temperature, right? You can say, well, we are in winter, we are expecting this average temperature. Now, it could be that there is a winter that is much milder, and you are not getting this low temperature that you calculated based on historical averages. That can happen, right? Now, because winter happens every year, we get a lot of data. Plus, people have observed weather for hundreds of years, right? Thousands of years, recording it in a scientific matter. With Bitcoin, if cycles are happening every 4 years, that makes it, if cycles were every year, we will already have a lot of data to do stats. We have only 4 bubbles, if you include even the first one before the halvings. So it's more difficult to do statistical calculation. And plus, also, there is a hierarchies in terms of what is long-term predictable and what is not. Like, for example, the power law, both in terms of theory, data, is much more robust pattern than this cyclic nature of these peaks, right? So it's not completely, it's kind of not an incredible surprise that maybe after 3, 4, 5 cycles, you start to see not behaving anymore like it's, we calculated. It's possible the irregularity were there in the beginning, and then this pattern starts to dissipate. They are not there anymore. We are not as strong as before. That happens all the time. Like, for example, there are these circadian rhythms in humans as we age. Like there are a lot of behaviors that follow almost like daily patterns. These daily patterns, as you age, they become weaker and weaker. And at the point where you don't see anymore, they are very irregular. People start to become much more irregular as they age, right? It happens. It's part of what happened with different systems. They became less regular as they became older. So maybe that is what happened with Bitcoin. It's becoming less regular. In the beginning, it was easier to keep a particular pattern, and now that is diluting. And this log periodic calculation is is kind of something that you update all the time. You bring in new data, and you are trying to look at, given the information that we have right now locally, what are we expecting? So it's more of a local calculation than a long-term pattern. So like I mentioned, that a winter can be milder or colder than what expected from seasonal trends. There could be a disagreement between the log periodic calculations and this calculation that we did based on the long-term trajectory. Is this how more or less what you think is going on here?
Sure, absolutely. I mean, the log periodic power law is normally applied within intervals of a couple of years, although some of the graphs I presented were longer term that are in Sornet's book, where he applied it over a decade. But it's difficult to apply over the whole Bitcoin price history. Giovanni and I have done some of that and found that it's, spotty. I found that you could sort of make it work through two adjacent bubbles, but certainly not over the whole history, because it's not the mathematical description of the entire history. The climatic mathematical description is the core power law, and these are phenomena that are punctuated on top of those with time frames of a year or two, right? A year up, a year down has been pretty typical, but that may be dissipating, and the approximate entropy calculations that I've done, show evidence for. There's still structure, there's still alpha, there's still advantage, but the bubbles are not all being focused into these single strong things. It's the volatility is kind of spreading out, and that's why you saw a double bubble perhaps, and maybe now we don't see a single bubble. We'll see. And we've got many different players, we've got a much deeper market, and so you expect that kind of thing. That is a maturation process for the market.
Correct. So and models are still useful because you can compare, right? You can say, okay, if a trend continue, this is what we're expecting. We see something else, so it means that this trend is not continuing. Something is different, and this is why it's still, like I say, Steven said, there is alpha, because if we didn't have these tools, we were going to use just rituals and magic and fantasy, right? So even when the weather prediction is 70% of chance of rain tomorrow, right? Is better than I don't know at all. It could be anything, so there is some little alpha in that, right? You say, okay, 70% chance of rain. Let me bring the umbrella, right? If it is 0 chance of rain, maybe I should not bring the umbrella, right? It guides you a little.
Our alpha is very high. We have very high alpha. It's over 0.9.
We are very high. Exactly. So anyway, all right. Thank you guys to be with us on this Wednesday evening. We will see you next time again.
Thank you, everyone.
Bye.